and welcome to Gopal Snacks Limited Q4 FY26 earnings conference call hosted by Emkay Global Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode, and there'll be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. I now hand the conference over to Mr. Rajesh Kumar from Emkay Global Financial Services Limited. Thank you, and over to you, sir.
Good afternoon, everyone. I would like to welcome the management and thank them for this opportunity. We have with us today Mr. Naveen Gupta, Chief Business Officer, and Mr. Regan Raithata, Chief Financial Officer. I shall now hand over the call to the management for the opening remarks. Over to you, gentlemen.
Thank you, Rajesh. Good afternoon, and thank you for joining us for the earnings call. We hope you all had a chance to go through our investor presentation uploaded on the stock exchange. We'll share our key operating and financial highlights for the quarter and full year ended March 31st, 2026. As we reflect on Q4 and full year FY26, it has been a year of steady recovery, operational stabilization, and consistent execution for Gopal Snacks. Despite the challenges encountered earlier in this year, we have made meaningful progress in strengthening our manufacturing footprint, improving supply chain resilience, and expanding our market presence. During the quarter, we reported revenue from operations of rupees 409.6 crores, reflecting 29% growth on a YOY basis. For the full year FY26, revenue was at 1508.2 crores, reflecting the growth of 2.7% as compared to FY25. The performance during the period was supported by improved product availability, steady demand across key categories, and continued expansion in our distribution network. During the quarter, we witnessed stable demand across our core categories, supported by improved product availability and continued traction in key segments like Gatia, Namkeen, and Snack Pellets. Our focus on strengthening core categories along with increased expansion into newer markets has supported overall growth. A key milestone during the year has been the successful ramp-up and stabilization of our Modhaka facility, which is now fully integrated into our manufacturing network. Alongside our Nagpur plant, these facilities have played a critical role in improving production efficiency and ensuring consistent product availability across regions. During the quarter, the industry witnessed challenges related to gas supply restrictions. However, we would like to highlight that our proactive approach towards adopting alternate fuel sources, including the use of biocoal at our Modhaka and Nagpur facilities, ensured that our operations continued without any disruption. This not only highlights our operational resilience, but also supports our long-term focus on cost efficiency and sustainability. On the distribution front, we continue to expand our reach through deeper penetration in existing markets as well as entry into underserved regions. Our focus on our SSD model and addition of 125 micro distributors has enabled us to improve accessibility and strengthen our presence across geographies. In terms of branding and marketing, we maintain momentum through targeted campaigns, strategic partnerships, and enhanced on-ground visibility. Gopal Snacks has undertaken targeted marketing initiatives, including bus stop branding, branded bus stickers, out-of-home advertising, and campaign across premium digital platforms such as Jio Hotstar, Sony Live, and Spotify. These initiatives have supported brand recall and consumer engagement across key markets. We also continue to strengthen our back-end capabilities through improvement in our distribution management system and ERP integration, which has helped us in enhancing supply chain efficiency, improve inventory visibility, and support better decision making. With this improvement, we continue to strengthen our distribution network, which now includes over 953 distributors, which was 884 at end of Q3. Looking ahead, our focus remains on driving sustainable growth through continued investment in capacity, strengthening distribution, and enhancing brand visibility. With a more efficient manufacturing network, improved operational efficiency, and a disciplined approach to execution, we believe Gopal Snacks is well positioned to build on its growth momentum in coming years. I would now like to invite our Chief Financial Officer, Mr. Regan Raitata, to share his perspective on the financial performance during the quarter.
Thank you, Naveen bhai. Good afternoon to everyone. Let me take you through the key financial highlights for the quarter and the full year ended 31st March 26. Starting first with the quarterly performance. During Q4 FY26, we achieved revenue from operations of rupees 409.6 crores, reflecting a growth of 29% YOY basis and 2.2% on quarter-on-quarter basis, supported by stable demand trend and improved product availability across markets. Gross profit for the quarter was at 113 crores, translating into gross margin of 27.7% with a growth of 76.9% on YOY basis. Margins during the quarter were supported by improved operational efficiency and stable input cost environment. EBITDA for the quarter was 31.5 crores with an EBITDA margin of 7.7%. During the quarter, company also spent around 1.2% on the advertisement cost. The improvement was driven by the operating leverage, better capacity utilization, and continued cost control. Profit before tax, before exceptional item was 22.4 crores, while profit after tax was 29.9 crores, resulting into PAT margin of 7.3%. Now moving on to the full year performance. For FY26, revenue from operation was at 1,508 crores, reflecting 2.7% growth over the previous year. EBITDA for the full year is 101 crores with a margin of 6.7%, supported by gradual improvement in operations and normalization of supply chain during the year. Profit before tax, before exceptional item was 60 crores and profit after tax is 73.7 crores with a margin of 4.9%. With regard to insurance, during the quarter, we received 17.5 crores as an additional insurance proceeds as a part of our ongoing claim process, taking the total receipts during the financial year to approximately 37.5 crores. The process of asset restatement is in progress and we remain confident of recovering the balance claim in due course of time. Recently, we have updated to the stock exchange regarding the Rajkot manufacturing production facility commissioning. With this, the installed capacity of Rajkot plant is 105,000 metric tons, and with this, we also complete our restatement of the Rajkot manufacturing facility as far as production facilities is concerned. This plant will have a manufacturing diverse portfolio of gatia, namkeen, and snack pellets. With the initiation of Rajkot plant, company will discontinue the Gundal facility. Commissioning of this plant will lead to improvement in operational efficiency and will also improve supply chain for sales in Saurashtra and Kutch. As we move on into FY27, our focus remains on expanding our market presence, improving operational efficiency, and driving growth across our key product categories. With the strengthened operational base and disciplined capital allocation, we remain confident of sustaining the growth movement. We are confident that Gopal Snacks strategic initiatives backed with a strong financial and operational performance will continue to deliver long-term value for our stakeholders. Thank you, and over to you, Rajeshwar.
Thank you. Ladies and gentlemen, we'll now open the floor for questions. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Nitin from HDFC Securities. Please go ahead.
Yeah, hi. Thanks a lot for taking my questions. First, congratulations on getting the Rajkot facility back to operations. My first question is with respect to top line. So with 100% supply resumption, so FY27 will be a catch-up journey. So how do you see the top line shaping up, and could you break down the key growth drivers ahead?
Hello, Nitin bhai. Thank you for your question. So,
sorry to interrupt you. Can I request you to come a little closer towards the speaker and talk?
Yeah, sure. So Nitin bhai, you want a breakdown from product perspective or from geography
No.
perspective?
So like given the current demand setting, how do you see FY27 shaping up? And broadly, qualitatively, if you can highlight like what are the sort of strategy steps we are taking to sort of drive growth or whatever the target we have for FY27? Not product specific, in general, like how you are going to go for the growth ahead because your supply chain issues are now in the base. So
Right.
with 100% supply, you should do better. So just wanted to sense like what is your aspiration for FY27 and how the growth drivers will be.
Okay. Both attributors we are talking about, right? So in our core market, uh, we have taken an aim of growing to generate a delta of around 170 to 180 crores on annualized basis. And main growth attributor in Gujarat will be, as I earlier stated, that split coverage, line-wise coverage. We had covered 24% of our beats by Q3 end on double coverage, twice in a week. By end of Q4, we already have touched 29% of our beats are on double service module. And by end of Q1, we have aimed to bring 40% of our beats on twice in a week service in Gujarat. Now coming to the focus state, there will be growth from two attributors. One is footprint expansion. So we can see that we added roughly 65-70 dealers in Q4 versus Q3. So that momentum will continue, and then there will be organic growth. So we are aiming 125 to 130 crores of growth from focus states, and from the other states plus quick commerce, railway, modern trade, etc. We'll be clocking around 35 crores delta on annualized basis. So from current year, we are aspiring and aiming a delta of roughly 330 to 350 crores.
Sure. Thanks a lot for a detailed answer. Next question will be pertaining to the inflation. So on current inflation, how are you placed with Q1 and what actions have you taken to pass on the effect to consumer? Additionally, like from a long-term perspective after GST and now with this inflation, just wanted to have a sense on like how sector formulation you see. So two parts to this question. First is on the near-term inflation and how we are countering it, and second is on long-term sector play.
So I Nitin, Regan this side. So as far as first part is concerned, there has been an increase in the raw material prices, which ranges in palm oil to packaging, which ranges from 15 to 20%, as far as our product basket is concerned. So, which if we look from the impact perspective, till now it is around 4.5%. So out of which majority we have been negate through reduction in grammage and increase in prices, and also through some our internal BOM correction. So majority of this has been negated. We are also reviewing the situation on a weekly and fortnightly basis. As and when required, we will further take the necessary steps to stabilize the margins as far as Q1 concerned.
And any sense on like this inflation, how is the impact on the unorganized players? So do you see that the shift is happening and plus rupees 5 SKU salience going down and shifting towards 10? Any thought you can offer there?
See, Nitin bhai, definitely whenever this cyclical thing takes place in our industry, so the unorganized sector players come under pressure. So there are two elements of this situation. One, we have not so far witnessed any, action from regional or local players. However, we can sense that they will be coming under pressure, and we expect that industry will ultimately have to take a call how to and when and how much transition will take place from 5 rupees price point to higher price point products. We have not so far witnessed any action from smaller players on this.
Okay, thank you. And lastly, like if you can sort of, given the current inflation setting, if you can guide for the margin we are attempting to do in this FY27. And also, like last year, we had a supply chain issue, so our logistic cost must have gone up. So if you can quantify what was the margin impact from the logistic cost. Thank you.
Yeah. So next year, for the margin front, as we have been guiding, we still stick to the same guidance, that is 8% to 9%. The drivers for this margin growth, obviously, from the operational point of view, since our Rajkot facility has stabilized, so we will get the full year as far as Rajkot facility is concerned. So that will definitely give us an impact, a positive impact as far as operational cost is concerned. Secondly, transportation cost, as we have been guiding earlier, post our Modasa commissioning facility, that will start flowing into the P&L. So in the current quarter also, around 0.4 to 0.5% benefit has flowed to our P&L, and that shall continue in the next financial year also. So owing to all these benefits and on the operational leverage, since our sales target is 20-25% higher, so that should also give us the benefit. So owing to that, we are quite confident that we will be able to achieve the margin between 8 to 9%.
Sure. Thanks a lot. Thanks for answering my question, and all the best for FY27.
Thank you.
Thank you. Next question is from the line of Avnish Roy from Nuvama Wealth. Please go ahead.
Yeah, thank you and congrats. My first question is, if I see your focus state in Q4 has grown slightly slower than core states, if you could tell us in detail more reasons behind this, and in terms of outlook, would you expect focus states to come back faster than core state in Q1 and Q2?
Yeah, Amnish bhai, hello. Typically, our Q4 historically have been lower than Q3. If you see 4 out of 5 years, Q4 has been lower than Q3. So growth percentage in focus state, if you compare with our core state, so core state was more impacted because of this fire incident. So base became depleted. So focus states are stable, and with footprint expansion, most of the footprint expansion will come in core states only, in focus states only. So we will definitely get back on track in focus states as well.
So near term, your core state can still grow faster than focus market? Your core market can grow faster near term?
Near term, definitely we can say that focus market and core market growth percentage will be at par, but on annualized basis, focus market growth will be higher than core market.
Understood. Second question is, in biscuit, we saw odd pricing of 4.5 and 9 rupee. In your markets, did we see this in your business also, that some players were selling at 4.5 and 9 rupee? And have they come back in case they had cut to this odd pricing?
No, we didn't see this odd pricing in our industry anywhere. And I'll fail to comment on how they will, revise the pricing in near future. I'm sure that they will come to the normal pricing regime very soon, because inflation pressure will start biting them as well.
Understood. Now, last question. Last 2 months, of course, India has seen the GLP, that weight reduction, drugs, medicines, sharp reduction in prices. Long term, would you be concerned on this? I know India is such a large market, mass market, and these are still reasonably expensive for most Indians. But from a conceptual thought process point of view, obviously in developed market, this is a concern for all junk and these kind of categories. Would you be concerned that medium long term, as India, a lot of the middle class especially, this could become a concern? And then I'm sure you'll say that you'll go for all this healthy snacks, etc. But if you can address this from a conceptual stage.
So, we will have to deep dive into more data, let me tell you, in India, uh, per capita consumption of snacking from organized sector is still far lesser than developed countries, right? So typically, price point as well as snacking industry in India will continue to grow. Coming to this healthier snack kind of thing, this phenomena is largely confined to quick commerce and quick commerce as of now because consumer, the TG there and in GT are totally different.
Understood.
In
Last,
in previous in historically, if I name few bigger brands like whether listed or unlisted, they have attempted multiple times to introduce baked chips and healthier snacks and all those. Still, their contribution is below 2% on the national average. So in terms of percentage, we may see at a 40% growth, healthier snacks may 50% growth, but base remains very very low. So we don't see any threat to our industry. However, as we stated earlier in our commentaries as well, that gradually we are trying to, reduce our dependence on palm oil-based products, but not at cost of our, core products. Like in recent times, we introduced kaju biscuits, wafer biscuits, popcorn, noodles, rusk, wafer rolls. All these products are, non-palm oil-based products. And very recently, in last 15 days, we have introduced cupcake, we have introduced, 10 rupees price point drinks, etc. So we are consciously doing that, but not at cost of our core product. And we don't foresee a decline in any consumption pattern on snacks category.
and sir, one last follow-up. This time El Nino is there, and so deficit in rains 7%, 8% is possible. How does this impact your rural consumption in H2 of FY27? And in terms of inflation, can pulses also see inflation because of all this? So your RM and demand both could get impacted in H2?
As far as raw material is concerned, our basic raw material, which is chana and potato. So for the next 6 to 8 months, we have the sufficient stock, which is as per our requirement. We have stock almost till the end of November. So any increase in the prices of the pulses will not impact our profit.
Second half?
So second half, probably around November, December, yes, we need to buy from the market. So at that time, we'll go across, but then option is also there, like in the FY 25-26, the imported option was also available as far as chana is concerned. So we took the price benefit over there also. So similar options we'll explore in the Q4 as well when our requirability is there.
And demand side?
We don't see any downside in demand only. We don't find any major reasons for any downside in demand.
Okay. That's all from my side. Thank you.
Thank you.
Thank you. Next question is from the line of Resham Mehta from GreenEdge Wealth. Please go ahead.
Yeah, thank you. So the first one is, on the fire, the loss related to fire that we had booked was around 47 crores, and I think we've received around 37 crores. So how likely, we can expect the balance 10 crores claim to also kind of go through?
Resha, it would not be balanced 10 crores. It is the higher amount than that. The reason being that we have gone for the restatement, and whatever we have written off in books of accounts was based on WDV uses. So our restatement cost is obviously much higher. So that we can expect by probably Q2 for that money to be coming into our P&L.
And so how much is that incremental amount that we are expecting, assuming they are, they give us the full benefit of the restatement?
It would be somewhere in the range of 35 to 40 crores.
Okay. And with all this fire incident and the supply chain issues, we had lost market share, right? So since the Modasa plant started somewhere around in November of 2025 and the supply chain issues majorly got resolved, so since then, have we seen that recovery of market share or regaining whatever shelf space that we would have lost? How is the traction being there in terms of regaining the market share? And maybe if you could split that in terms of your core market, Gujarat, and the Rajasthan, I believe, was also impacted. So you could comment on these markets.
Right, Sanjeev. Thank you for your question. We are witnessing improved trajectory from March onwards, to be very specific. And right now, as well, our current run rate is an indicator that we are on recovery path in terms of our lost market.
And this is across all markets, right? Core focus.
Yeah, now we can see the per day run rate is across markets. In fact, even Uttar Pradesh in H2 has been more than 26% over H1.
Right. And just coming to your raw materials, right? So if you could call out what is the RM basket? Like chana and potato are the major ones, but would they be like what, 40-50% of the total RM basket? And also if the other major ones like palm oil and laminates, if you could comment.
Yeah, so as far as our purchase basket is concerned, so major are palm oil, chana, laminate, and last is the potato. If I talk about palm oil, it is around 26 to 27%. Chana is around 21 to 22%. Laminate, that is packing material, it is around 18 to 19%. And potato
Sorry, I missed that. What is 18 to 19%?
Laminate, packing material.
Right. Okay.
And potato is around 6%. This I am referring from the purchase basket.
Potato is 6%, right? Okay. And considering that to regain market share, of course, we would have had to spend more on trade spends, and also we are seeing an inflationary trend. But there, you all seem to be reasonably confident of passing on whatever inflation you all are seeing. Right. So with that, and the fact that now with the Rajkot plant coming in and we are seeing some logistics cost benefit and labor costs and power cost benefits, wouldn't you say, and the fact that we've already started regaining market share, then in that light, wouldn't your guidance of 8-9% EBITDA margin for the next financial year for the current financial year FY27, doesn't that seem to be on the conservative side? Because if gross margins, can be protected and your operational costs will be going down, and assuming you're regaining market share, then your trade spends should also kind of be pared down. So, just your thoughts there?
So as far as trade spend is concerned, we would be obviously looking on that front, but that our reduction on the trade spend would be in a very gradual phase-wise manner. So on an immediate, let's say in 26-27, it is not, we would not be looking on a major cut as far as our trade spend is concerned. Yes, our advertisement spend that will continue to have, like in current financial year, we have spent around 1.7%. So next year we are projecting another 2.2 to 2.3%. So that's where we continue to spend. And secondly, when we say the guidance of 8 to 9%, it is purely based on current volatility of the raw material prices. And we are quite confident that our exit run rate would be near to double digit, although average annualized EBITDA margin will continue to remain 8 to 9%.
Thank you. Desam, I'll request to come back for a follow-up question, please. Thank you. A request to all the participants, kindly limit yourself to 2 questions per participant and rejoin the queue for a follow-up. Next question is from the line of Soham from Motilal Oswal. Please go ahead.
Yeah, thank you for the opportunity. Yeah, I just wanted to check, Naveen ji, as you guided this 330 to 350 crore data for FY27, On product-wise, how do you look? So basically, we have product like Gatia, Namkeen, pellets, and wafers. These are the four category majorly we have. On product-wise, how do you look for next year on growth-wise?
Yeah, Sombhai, before I answer specifically to your question, let me give a clear statement that improving market share, protecting market share is to be paramount for us. So, Reshaji was asking about this trade spend thing. We are on, very good business model in terms of our very least dependence on super stockists. So 97% of our business comes through direct distributors. So we will start reaping benefit of distribution automation on full scale from H2 onward. Then we will definitely look into cutting down some of our trade spend. Now coming to your question, Sombhai, Gatia we have a base of roughly 410 crores. So we are aiming 18 to 20% growth from Gatia segment. Namkeens we have a base of 350 crores. We are aiming 15% growth in this financial year. Prams we have a base of 250 crores. So we are aiming 15% growth there. Wafers we have a base of 155 crores. We are aiming 40% growth there. And all other products put together, be it papad, retail packs of besan, spices or bakery products or noodles or rusk, etc. We are aiming growth of 30%. So that is a split of category wise.
Okay, and if we look these three categories like Gatia, Namkeen, and pellets, if you can give how this industry has been growing in Gujarat, because majority of our growth rate is still on the Gujarat. So I just wanted to check in last financial year, how this product-wise, Gatia, Namkeen, how this category has been growing in the Gujarat market.
Our assessment is that Gatia has a growth of 15 to 20% in Gujarat, and Namkeen, industry growth itself is 14-15%, and Prime growth must be in line with the industry growth, only that 15% kind of.
Okay. And what kind of capex we are doing for next couple of years? I believe it's only maintenance capex, right?
Yeah, so our majority of expansion capex has been done. For the next financial year, what we are looking at 40 to 45 crores kind of a capex, which would include some of the our corporate office building at Rajkot. So that capex will happen in this financial year, and that would be maintained.
Thank you. Soham, may I request you to come back for a follow-up question, please? A request to all the participants, kindly limit yourself to 2 questions per participant. Next question is from the line of Sri Narayan Mishra from Baroda BNP Paribas. Please go ahead.
Thanks. So my first question is on capacity utilization on slide 11. Are the numbers for 4Q or full year?
So that is for full year basis.
Full year. So on 4Q basis, would you have the capacity utilization?
It would be almost near to that number.
Okay. So why I'm asking this is that when you are saying your EBITDA margins would be at a double-digit exit rate in FY27, what kind of capacity utilization you expect, from the 300-350 crore incremental sales that you would be doing in FY27?
So capacity utilization would be roughly around 43 to 45%.
Thank you. Srinath, kindly come back for the next question. Next question is from the line of Pallavi from Sameeksha. Please go ahead.
Yes, sir. Thank you for taking my question. I wanted to understand on this the rusk and cupcake, this others category. What would be their share? Is it more from the core markets we're getting these revenues, or it's also focus markets?
So Pallavi, we do pilot of any new product first in core states, and that too in selective parts of core states. Then we roll out to the other states. So for example, we did pilot of Kaju biscuit as well as popcorn first in Gujarat, that too in limited parts of Gujarat. Then we rolled in entire Gujarat. Then we went ahead with the full all the geographies. So right now we released this cupcake couple of days back only in Gujarat only. Drinks the same treatment we released 15 days back in Gujarat only. Will see the response, and if response is good, then only we'll roll out in the rest of the geography.
All right, sir. So it said, we have shown 26% growth in core markets. So how much of that would have been contributed by these new products?
Just give me a moment. From the new products, you wish to ask whatever new products we introduced during the financial year?
Yes, one year.
Yeah, so this you are
popcorn and Kaju biscuits.
How much was the contribution from new products?
Or roughly you can say if it's been a big driver for this core market growth, or just a broad sense if you can give us.
Yeah, just give me. So हमारा ये 25 crore से it has gone to 63 crore in full financial year. So this delta, out of this delta of 38 crores, roughly 50 crores has come from core states.
Right. Okay. And so my second question would be, what the other margins for these new products, would they be lower than the existing products? Popcorn, I believe, should be higher. Yeah.
Yes. Popcorn is higher. Even wafer biscuits are more or less in same line of margins as of our existing products.
Okay. And so, then
just to update you, we have been doing another exercise. We have been rationalizing our product basket by eliminating low margin, low contributing SKUs and even products. And we have been trying to, promote the high margin, high contribution products.
Thank you. Pallavi, I'll request to come back for a follow-up question, please. Next question is from the line of Shirish Pardeshi from Motilal Oswal. Please go ahead.
My congratulations for Rajkot plant reinstatement. Good afternoon, Naveen and Regan bhai. On slide 27, we have given the breakup of SKU price point. I see that large pack has gone up by 300 basis point and 5 rupees has come down by 300 basis point. So I just wanted to understand and assess your thoughts in terms of margin, how it moves, because 5 rupees obviously will have a lower grammage and also higher packing cost and even distribution cost. So if this number is changing by 200-300 basis point in FY27, how delta for the margin you will see?
So, Shirish bhai, historically our 5 rupees price point SKU have been giving us similar or better margin versus our larger pack. However, since dynamics are changing very fast, so when we rationalize the grammage in smaller packs, so simultaneously we are taking a price hike in bigger SKU as well. So this, 3%, 300 basis point reduction from 5 rupees price point is largely attributed to introduction of newer products, like we introduced this wafer biscuit. So wafer biscuit although remains 5 rupees, but however when we compute in our SAP, so there are 40 pieces in a jar. So for us in our system that MRP is 200 rupees. Got my point?
Yes.
So margin in our case, we work in industry like this whenever there is a pressure in 5 rupees price point margin, so we reduce grammage proportionately.
Okay, got it. My second question, now in terms of capacity, I mean, last year we have done some contract also arrangement. Now, what we understand now, Modasa is fully occupied, and there is a capacity utilization which will happen, but Rajkot is also started. So just wanted to understand if you give an overview what we are producing in Rajkot, what we are producing in Modasa, and what will happen to Gondal. So maybe in terms of manufacturing all facilities, how and where we are happening, and maybe we somewhere said that in UP also we will do only top 3 SKUs and try and expect the market, not giving all the products. So given this all, is the growth number is sacrosanct?
Yeah. So, Shresh, as far as Gondal facility is concerned, that will discontinue as we have started manufacturing from Rajkot. And Rajkot facility will have Gatia, Namkeen, snack pellet, extruded snacks. Modasa facility will continue to have all kinds of Namkeen as well as wafers. And Nagpur facility will have Gatia, Namkeen, snack pellet and wafers. So this is in line with our earlier guidance that all the 3 plants will produce almost all kinds of products except wafers. And as far as third party is concerned, so third party wherever we have communicated earlier that for the UP as well as Chhattisgarh and for the South, those third party arrangement has been done predominantly to improve the supply chain and to enter into those markets, which will help us to have our footmarks in those markets, wherein current our transportation cost was much higher. So we thought to pass on this additional transportation cost to the consumer through third party arrangement.
Just one quick follow-up on this. Yeah, I got that, Regan Bhai. So I'm just tying out the focus market growth on a QOQ basis is only 1.5%. The YOY is a function of capacity utilization and scale up, which has shown 25%. I'm more interested this growth which is in the focus market. We have this contract third-party manufacturing arrangement to streamline the supply. So what, I mean, on the backside, I also give credit to Naveen that there is a distribution scale-up also which has happened. But is this growth is too small or too large can come in FY27?
Yeah, तो शिरीष भाई मैं आपके पहले सवाल का जवाब देता हूँ. जो छत्तीसगढ़ में right now we are manufacturing third party के through wafers only, and in Kashipur we are producing only 4 SKUs which contribute to 76-77% of the Uttar Pradesh sales. Now coming to this Q4 focus markets growth percentage being lesser than expected, so my answer remains the same. Historically, our Q4 has been lower than Q3 to the tune of 6 to 7%. But this time we have reversed the trend. Q4 has been better than Q3. And now with the supply chain being stable, if you see our distribution footprint numbers, so for the first time now we have started this growth number again. Like we have declined in our number of distributors in Q1, Q2. Now since we have started adding those numbers as well, so growth will definitely come from focus markets as well.
Thank you. Shirish, I would request you to come back for a follow-on. A request to all the participants, kindly limit yourself to 2 questions per participant. Next question is from the line of Bhumin Shah from Equirus Securities. Please go ahead. Bhumin, may I request you to unmute your line and proceed with your question? The line for the participant dropped. The next question is from the line of Shreya Chatterjee from Ageless Capital. Please go ahead.
Hello, sir. Thank you for taking my question. On the top line side, could you just indicate what would be the number of dealers or the dealer expansion you're planning to do, and the revenue per dealer in the core and focus market, as well as if you plan to take any more grammage reduction or price hikes in your various products like Gatia, Namkeen, therefore?
Yeah, so Shreya, in Q4 we added 69 new distributors, and in entire calendar year we have we took an aim to add 250 distributors. So we are on right track, number one. Coming to this grammage reduction, we already took roughly 4% grammage reduction in mid of April itself. And now we keep observing and we keep tracking competition activity. We will take another call based on how industry reacts. Definitely there will be internal factor that how much inflation impact come on us, but definitely we will see how industry also reacts.
Got it. And if like on that follow-up question, what would be the revenue per dealer, like for the mature markets, core markets, and the focus markets when the dealers mature?
In core markets, right now our run rate is close to 85-90 crore rupees, and we have a base of 300 distributors. So run rate will be close to 30 lakhs per month per dealer. And in focus markets, typically we do 400 crores on annualized basis. So that converts into roughly 35 crores on monthly basis on a base of 600 distributors. So range of, size of scale of business of a dealer varies. To start with, we start dealer with a top line of around 1 lakh to 2 lakhs only. Then gradually it goes up. So we have, very different range. Like in Chhattisgarh, we have a dealer of 1 lakh as well, and we have a dealer of 70 lakhs as well. In Rajasthan, we have a dealer of 1 lakh as well, and we have a dealer of 65 lakhs as well. So range will differ from state to state, and depends what is the age of that dealer.
Got it. So on the margin front, like the EBITDA margin front, while your gross margin has improved because of the restoration of Rajkot facility, but your other expenses has been generally elevated versus your previous years. Like you used to do much lower SG&A to sales previously compared to FY26. So do we see that trend going forward? Also, your receivable and inventory days have also increased on FY26. So what do you see to be going forward?
As far as receivable days is concerned, it has increased, and if you look at number of days, it is 9 days, but we are also able to negotiate our trade payable days. So as far as overall working capital cycle is concerned, still it remains in our comfortable. Secondly, if we look at, you are referring to full year margin trajectory, correct? Hello.
Hello, I'm referring to the other expenses part.
Other expenses part, so that includes the transportation cost, advertisement cost, and all other pertaining to operation cost, which is contractual manpower. So as we say, for the next financial year, definitely we would have a margin benefit front since our operational leverage as on the additional sales. So we expect on an overall basis it would increase, but if you look from the margin perspective, it should give us benefit of around 1%.
Thank you. Shreya, I'll request you to come back for a follow-up question. Next question is from the line of Ashok Shah from Eklavya Invesco. Please go ahead.
Thanks for allowing me to ask the question. Sir, Naveen bhai, can you just give me some guidance? What is the size of the order from the retail counter quarter and quarter wise we are getting? Whether it has increased, and do we offer them a bidding or booking system to retail counter in a village area? Because today don't have got a
You are asking about retail counter?
Yes.
So nationally, we are catering to 3.9 lakh dealers through our DMS system. And as far as indirect distribution are concerned, through wholesale channel and other channels, estimated presence is at roughly 1 lakh more outlets. So we at national level are present at 5 lakh outlets.
So do we give them any of the app-based booking system? Directly booking comes directly to our manufacturing plant, and we have got a control over our products and everything. Because one of the other industry has done such a system, and they have lots of saved on the shelf system and distribution system. As our distribution first goes to the our distributor, our product goes to first distributor, then it is kept there for 2-3 days, and then it is distributed. So product inventory and everything goes doesn't go directly to the consumer. It goes to the number of channels.
Yeah. So since why not clear, but whatever question I could get, let me explain you how our DMS functions. At 90% of our dealers, our fully integrated DMS is operational. So it is mandatory for them to book the order through that interface only. They book, so that booking is visible to us on real-time basis, live basis. So we track secondary sales. We can track secondary sales on daily basis, on hourly basis. Basis that secondary trend, we have yet to introduce auto replenishment system to our distributor. That work is in pipeline, that is work in progress. As of now, distributor place order to the company, so 6 p.m. is the cutoff. Basis that order, we supply those stocks within 48 hours. This is how we function as of now.
Thank you. Next question is from the line of Anuj Kashyap from A3 Capital Private Limited. Please go ahead.
Hello, I'm audible?
Yes, sir. Go ahead.
Yes, sir.
Sir, just I wanted to know, bhai, how much amount of money do you spend on the innovation? Because I see a lot of money is chasing this sector. The Leo City-based Balaji Wafers have got a good amount of money from the private equity fund. So, sir, हमारी company कितना पैसा innovation वगैरह पे या research पे आप कह लो खर्च करती है?
So if you are asking about product innovation,
yes.
That's very simple methodology, Anuj bhai. Our marketing team, they do market work, they do research on the basis of what is scalable and which are the growing categories. So basis that they come with product sample and then they give their recommendation. Then we assess whether those products are manufacturable and are profitable to us. And then we assess if those products have synergy with our existing product basket, if they fit to our existing distribution network or not. So in terms of product research, we do not spend any heavy money. So everything is in-house. As far as other research reports are concerned, so last financial year we had hired Kantar, and we got a research report from them that was based on Gatia specific. So we paid just 30 lakh rupees amount to them.
And sir, last time I remember in one conference हमने export का भी जिक्र किया था कि हम export में हम अपने आप को थोड़ा बढ़ाएंगे. So what is your take on it, sir?
After stabilizing of this supply chain thing, we have resumed our exports to selective countries to our older customers. Right now we are in discussion with a company who is 100% EU company and has a good consumer base over 66 countries. So we intend to do a third party tie-up instead of bringing scale through our internal efforts, because those are time consuming and costlier ways.
Yes, sir. That leaves margin lucrative then. Yes, sir. Thank you, sir.
Thank you.
Thank you. Next follow-up question is from the line of Srinaran Mishra from BNP Paribas. Please go ahead.
Thanks for the follow-up. My question is on debt level and working capital levels. This seems to be a bit elevated. Is it in the wake of rising cost inflation that you have piled up inventories, and because of that, should we expect higher finance costs next year?
The working capital has increased earlier, primarily on account of we have stored more amount of chana as compared to last year, and we are expecting prices to increase in 26-27. So definitely the bank borrowing has gone up purely on account of working increase in our inventory level. Secondly, as we would be expecting insurance proceeds to also give us some amount into our P&L. So we are expecting that should reasonably maintain our finance cost for next financial.
So you are guiding similar finance cost next year or higher than last year?
It would be slightly higher than the current financial year. So if we look at overall our finance cost for the current financial year, it is around 7 crores. So we are expecting roughly to close around 10 crores.
Okay. And sir, last quarter you had highlighted in UP that we are doing 6 crore monthly sales from top 2 SKUs. So what's the update there in 4Q? Has it increased or what's the update for UP?
Our total per month sale is 6 crores in UP, and out of that 72% sales come from 2 SKUs alone. So our H2 has been very promising. H2 there has been turnaround in UP, and we have grown by 26% in H2 over H1 in Uttar Pradesh.
So what's the run rate now? Monthly run rate?
Currently monthly run rate is 6.5 crores, 6 crores.
Okay. So basically that can grow by FY27 and to 7-8 crore or 9 crore?
We expect since UP is amongst our focus market, and we are targeting a growth of 35% from focus market. We had started this Kashipur thing somewhere in October, November. So one of the attributors to growth in UP has been that third-party operations from that Kashipur plant. So we expect that momentum to continue, and we expect this exit should be around 8.5 crores to 9 crores.
Okay, thanks.
Thank you very much. Ladies and gentlemen, we'll take that as the last question. I now hand the conference over to the manager for closing comments.
I would like to thank everyone for joining this our call, and I hope we have been able to respond to all your queries satisfactorily and adequately. If you feel further any information is required, please get in touch with us and with our investor relations team. Stay safe, stay healthy, and thank you once again for joining us. Thank you.
Thank you very much. On behalf of Emkay Global Financial Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line. Thank you.